If you invest $100 a month, which is less than $4 a day, and you can get an average 10% return on your money, it will take you 45 years of you investing this $100 a month to retire a millionaire. So if you start at 21, you will retire a millionaire at 66 years old based off your $100 a month investment plan. If you can get a little bit more aggressive, now you can invest, say, $500 a month, and you can get the same 10% return. Well, now it'll take you just 30 years to retire a millionaire. If you can get even more aggressive and you can invest $1,000 a month, well, now it's only going to take you 23 years to retire a millionaire. So if you start at 21, you'll be a millionaire by the time you're in your mid-40s. And if you can get even more aggressive and you can invest, say, $2,500 a month, and you get the same average 10% return a year, well, now it's only going to take you 15 years to retire a millionaire. Becoming a millionaire is very accessible in your lifetime, even if you don't have that much money to start, but it takes consistency, because when most people think about investing their money and becoming successful, they think of hitting the jackpot with the stock. You're going to take $10,000 or $1,000, you're going to put it into this one stock, and then 60 days or 6 months later, your money is gonna 5x because you made a very good investment, and then you can just recycle that, and you make a few good hits, and then you're gonna be a millionaire. But for most people who actually become wealthy, that's not how it works. It's through slow, steady, consistent investments where you keep putting money away, and then you build this investment plan where now your money's being put to work and is growing each and every year. That way now, not only are you investing more money, but your money that's being invested is growing as well. Now, this doesn't mean that you're never gonna see down years. Like recessions and market crashes are a part of our economic system. We've seen some sort of economic slowdown or recession once at least every 10 to 15 years for over a century now. So recessions and market crashes are a part of our system. So it doesn't mean that your investments have to go up every single year. It just means that you stay consistent, and every year you keep investing your money, because some years you're going to get better returns than others. The second issue that I've seen from my years here at YouTube University is that you have some people that'll say, I don't want to wait 15 years to become a millionaire, let alone 45 years. So what's the point? Because that's so far out. Well, the reality is this time is going to go by anyways. Like 15 years from now, you're going to be 15 years older. 45 years from now, you're going to be 45 years older. And if you don't start putting aside some money now, the time's going to go by, and then you're going to be broke then as well. So you can choose. Do you want to be broke now and broke later? Or would you rather be broke now and rich later? Now, I would rather be broke now and rich later, which means I would rather put my money aside to invest, because I know that I'm gonna get older, and I'd rather have more wealth because now I have more money to use. Now the question is, how do you actually manage your money? That way you can become successful sooner rather than later. And the very first thing that you have to do is you have to create a plan for your money. And what I like to recommend is doing something like a 75-15-10 plan, and you can create something like this that works better for you. But what a 75-15-10 plan says is that from now on, anytime you make a dollar, 75 cents is the maximum that you can spend, 15 cents is the minimum that you're investing, and 10 cents is the minimum that you're saving. So now you make some money, it's gonna flow through this funnel. This is how much you spend, this is your investments, and this is your savings. That way now, no matter how much money you make, you're always putting money aside towards your investments, you're putting money aside towards building your savings, and you have money to spend. This is where your wealth is built. Your wealth is built through your investments. Most people assume that the more money I earn, the wealthier I will become. But that's a big lie, because the misconception with that is just because if I make a big salary, I'll be wealthy. But what happens to so many people is you make a big salary and you increase your spending, but you don't increase your investments, you don't increase your savings. The way you become wealthy is by having more investments. That is, plain and simple, the way you become successful, the way you become financially wealthy, you own more assets. Your savings are not gonna do it. Sorry, mom and dad, and every other Indian uncle and auntie who say that you need to save your money to become wealthy. Your savings are there to protect you against an emergency, but your savings will never make you wealthy, because you cannot outsave inflation. If inflation is higher than the interest rate at your bank account, then your savings in your bank account are losing value to inflation each and every day, aka you're becoming poorer each and every day. Now, this does not mean you should not save any money. This means you should save money smartly. Save money for an emergency, have somewhere between 3 months to a year's worth of expenses saved for an emergency. So if you lose your job, something bad happens, your kid breaks their arm, your house goes down, something happens, you have cash to fall back on. Second, save money for an investment. You want to buy an investment property, you want to buy a business, you want to buy some stocks, you have cash for that. And third, save money for a big purchase. You want to buy a home, a car, some jewelry, you have savings for that. Those are the 3 reasons why you save your money. If you're just saving your money to save it, you're becoming poorer each and every day. Then you should always be working to grow your investments. Once you save enough money, move this money here because this is where your wealth is going to be. This is the money that you live off of. This is the money that you have to go on your vacations, to eat out, to have the nice stuff. This is the stuff that you're working for because you want the nice stuff. But this is not where your wealth is going to be built. This is what makes everybody else rich. Because this is the money you're spending at Lululemon, at Amazon, at Kroger, at everywhere else. All this money is making other people rich, which is fine. You want to have the nice stuff, but you want to make sure you're paying yourself first. Now, if your goal is just to have a passive and automatic system where this money gets automatically invested and you don't have to think about it, then what you can do is open an account with something like M1 Finance. It's free to do, and then you can create a portfolio of different ETFs that you want to invest in. An ETF is a basket of companies. So instead of investing in just, say, the McDonald's Corporation, you can invest in an ETF that gives you exposure to 500 of the biggest companies on the stock market, and McDonald's might be one of the companies in those ETFs. So now you invest in just one ticker symbol, which will give you exposure to 500 different companies. That way now you can be completely hands-off. It can be passive because now your risk is a little bit lower. And the nice thing now is you can create a portfolio of different types of ETFs. Some that give you exposure to the biggest 500 companies in the stock market, some that give you exposure to dividends, some that give you exposure to emerging markets, some that give you exposure to innovation and technology. You can figure out your own portfolio of ETFs, what it is you want exposure to. And then you can set it up where now every week or every 2 weeks or at least every month. Ideally, you want to do it at least every month, but the best case scenario is every week. You have money that's automatically going to leave a checking account, and it's going to automatically be passively invested into these different ETFs that you want to be invested in. I mentioned M1 Finance because that's something that I do. If you want to use my affiliate link for M1 Finance, I got the link down in the description. If you use my link, we will get compensated, but you can do your own research to see what's the best platform for you. I like M1 Finance because it's super simple and it's completely free for you to be investing your money. The second thing that I want you to do when it comes to effectively managing your money to become successful is right here when it comes to your savings. Because now that we're seeing interest rates significantly higher than they were before, some bank accounts are paying better interest rates than before. Not all bank accounts. And this is where you want to have a high interest savings account where you can leave your savings. A high interest savings account is a savings account at a bank. So you want to make sure it's a reputable bank that's FDIC insured where you can keep your savings and get easy access to your savings while getting a better interest rate. Like at the time of me recording this video, there are a number of high interest savings accounts with banks that are online that'll pay you somewhere between 2.25% to 2.75% interest a year. Now this is going to fluctuate with interest rates, but right now you can get more than 2.5% interest a year on your savings that's FDIC insured at a reputable bank. So this means now looking for an online bank and moving your savings that you don't need every single day there. Now, the difference between an online bank and a physical bank is that with an online bank, it's only online. You don't got your physical presence. So if you want to move your online money to your physical bank, it might take a few days. That's why you want to move money that you're not going to need tomorrow, money that you would only need in case of an emergency, in case something bad happens, where at least you're getting some sort of return on your savings that are sitting there doing nothing. So move your savings to a high interest savings account. That way you can get some returns. If you're looking for some high interest savings account, I'm not being paid by these companies. A few examples are CIT Bank, Ally Bank, E-Trade has one, and there's a couple others, but you can check out some of these high interest savings accounts to see how you can start earning more interest on your savings. Third, if you want to amplify the process of building your wealth and having nicer things, then the next thing you want to do is start earning more money. Now the question is, how do you earn more money? If you hate the idea of starting a business, if you hate the idea of being a freelancer, if you hate the idea of working outside of your job, fine. Then find a way to earn more money at your job. Or if you don't like your job, look at getting another certification. There are so many different certifications out there that can help you start earning more money. It's going to require you to invest some money into your own education, not necessarily going back to school and getting another degree, but looking for an online certification. That way now you can get a better and higher paying job. If you want to do something outside of your job, great. Well, now you can look at creating a side hustle, creating your own business, or becoming a freelancer of some sort. This could mean you becoming a virtual assistant. This could mean you become a virtual salesperson. This could mean you become a virtual video editor. This could mean you become a virtual photo editor, a graphic designer. This could mean you become a virtual writer. There are so many different opportunities out there depending on what your interests are. Like if you like accounting and finance, be a bookkeeper or start some sort of additional accounting firm. If you like graphic design, you could do video editing, you could do TikTok editing. I'm telling you, people pay a lot of money for TikTok edits. I know this because, well, we get a lot of TikToks created. You can become any sort of editor in that space. You can become a writer because good businesses need good content creators. So if you know what you like doing, or even more importantly, if you know what you're good at, and if what you're good at can help a business make more money, well, now you just need a way to get in contact with the right businesses. And this could mean now either you are directly contacting businesses, send people DMs, offer free services to get your foot in the door, send people cold emails, cold call people. I know it is hard to do cold emails and cold call because I have been in that business before. But if you stay consistent, once you get your first client, you can get your first testimonial, and that'll help you get the second client and the third client. Or if you don't want to go about doing that, then the next best thing would be to use something like Upwork, use something like Fiverr. I'm personally a bigger fan of Upwork than Fiverr, but you can try out some of these platforms to start getting in contact with businesses. That way you can offer your services to businesses. If you want to create something on your own without just being a freelancer, you want to actually build a business, great. Well, now you need a product and you need customers to sell your product to. How are you going to make money? Is it going to be a service? Can you offer accounting services to businesses? Can you offer financial consulting? Can you offer fitness services? Can you offer whatever, dating advice, marriage advice? That's your product, if this is a digital product, or maybe it's a physical product. Maybe you've invented something. You invented a better marker to write on whiteboards. If you do, send me a message. But if you have a product, now you need customers to sell it to. How do you get these customers? Start with social media. That way you don't have to spend thousands or hundreds of thousands or millions of dollars to start making money. Start marketing it on social media. Let your customers sell your product for you because you need to have a good product, and then you can start growing it from there. Now, if you are an entrepreneur, if you do have a side hustle, if you do have a business, I created a free newsletter called Business Briefs to keep you updated on what's happening in the entrepreneur and business news space. And it's not just the economy news, it's what's happening with innovation, it's what's happening with business and economic trends, it's what's happening with the funding side of entrepreneurship. So if you want to stay up to date on what's happening for entrepreneurs, business owners, founders, you can join Business Briefs for free. It's a completely free resource that I created for entrepreneurs. So if you want to join, I got the link to how you can join Business Briefs down in the description below. The fourth thing you have to manage if you want to become financially successful falls a little bit outside of this, but it's managing your time and actually valuing your time. And this is something that I have seen very closely with a lot of people and friends and family around me, where people will say, why would I want to pay somebody $100 to do something when I could do it myself? So the best example or easiest example would be in the real estate investing space. If you bought a real estate investment property, you bought a home, you could manage the property yourself, find the tenant, and make sure the tenant pays, and when something goes wrong, you can be the one calling the contractor, or you could do the work yourself, or you can hire a property management company who's going to take somewhere between 5% to 10% of your gross rental costs. They'll find your tenant, they're going to charge a fee to do that, they will make sure the tenant pays, they'll make sure your bills are paid, and if something breaks, they'll be the ones to call up the contractor, and then you got to pay the contractor to do that. Now, you might say, that's a lot of money. I could just do it all myself and keep these fees for myself, or you can pay somebody else and buy your time back. Because what you're doing when you hire the property manager and the contractor isn't just paying somebody, is you're buying your time back and you're buying that peace of mind. Because now your stress levels can go down a little bit, because now when the tenant calls you every 30 minutes, you're not the one who's going to get angry and upset, who's always stressed out because a tenant keeps calling you. You have somebody who is a professional who all they do is talk to tenants and make sure that everything is documented and taken care of. And now you just bought your time back. That way you can spend your time doing something to increase your wealth. like maybe looking for more investment properties. And this is where you got to decide. Do you want to be the investor or do you want to be the manager? I hate the idea of being a manager. I want to look for better ways for me to use my money. That way I can get a better return on my money instead of just trying to see how I can squeeze another 5 to 10% costs out. I'd rather try to increase my costs so I can grow the pie. And you see the same thing when it comes to selling real estate. See, when most people try to sell real estate, you'll go to a broker and a broker might say, well, I will list your home for sale with a 6% commission. So if you're selling your home for $300,000, that's 18 grand worth of commission. Now, I have worked as a real estate salesperson for a number of years, so I understand how real estate salespeople work. And what happens to most people is when the real estate salesperson says, I want 6% commission, then most people who are listing their home are going to say, that's a lot of commission. Will you do it for 5 or will you do it for 4? And some real estate salespeople will say yes. Others who are better real estate salespeople will say, if I agree to cutting my commission, how do you think I'm going to do when people offer a lower price for your home? But when I look for somebody to sell my home, or when I look for people to sell something for me, the last thing that I want is to undercut my commission checks. Because if you're trying to sell me something, I want you to be incentivized to sell my thing, not somebody else's. And so I'll work to create a plan where you want 6%, fine. How about this? If you sell the home for more than $300,000, I'll give you 7% commission. Now what are we doing? Now I'm incentivizing you to push my home and to sell my home for a better price. Because now when you have a buyer who's comparing 2 different properties, well, you're going to push your buyer to one home over the other. And which home are you going to push them towards? The one that's making you the most money. And in that case, that's my property. And so it's starting to think a little bit different. One, not just thinking of the limited scarcity mindset where there's a small amount of money in the world. Second, understanding that there's more opportunity, but also valuing your time. But now you can buy your time back, because once you buy your time back, you have more freedom to do whatever you want. You have more freedom to do things that could make you more money. You have more freedom to do things that make you happier. You have more freedom to spend time with the people that you care about. You have more freedom to give more impact to the world, but you have more freedom to decide how you want to use your time. But you don't have the freedom if you're constantly on the phone, if you're constantly doing everything. And sometimes, especially in the business world, we feel this need to micromanage and control everything. And if that's the way you are never going to be able to scale. And I get it, it can be hard. Hiring somebody, especially for the first time, is very difficult because you expect everything to be done your way, but you have to train and then delegate and then trust people to take care of the job. Now, this doesn't mean you never give any oversight. You want to make sure that people are doing their job, but there's a difference between making sure somebody's doing their job and micromanaging them. Every single person on this earth is given the same 24 hours, and the thing that separates somebody who becomes so incredibly successful and somebody who does not is how you use your 24 hours. And so if you are trying to make the biggest impact and see the biggest returns and see the biggest success, then you got to utilize how you're going to do those 24 hours. And you cannot do everything yourself, and you can utilize those 24 hours a whole lot better if you can start delegating and start hiring people who are smarter than you and trusting people to do their job. Because once you can start scaling that way, well, now you can do a whole lot more in this 24 hours because you got an army of people that are working to accomplish the same things as you. And finally, number 5, and the most probably obvious thing that you need to manage if you want to become successful, especially financially successful, is you got to know how to manage your spending. If you cannot control your spending, it does not matter how much money you make, you are going to be broke. I know people who are making multiple 6 figures a year. Actually, I know people who are making over $1 million a year that have no investments and very little savings. And now you might be thinking, how can somebody make $1 million a year, have no investments and very little savings? Well, when you have a very nice car, when you're flying on private jets, making $1 million a year, and just a little piece of information, if you're flying on a private jet, making $1 million a year, you are definitely using your money the wrong way. You are not making enough money to be flying a private jet. But if you're making $1 million a year, you're flying on a private jet, you have nice cars, you have a big home, you have a whole bunch of expenses, but you have no actual real wealth. Because if your income goes away, well, now all the nice stuff goes away too. And this is where you got to understand, what do you want? Do you want to look like you're rich today? Or do you want to actually be rich tomorrow? This is going to make you look rich today. Your spending is going to make you look rich right now. You can spend a whole lot more money than you make. Just go into debt, spend it on your credit card. You'll look like you're really rich, but it's going to keep you from becoming rich tomorrow. Because when you go into credit card debt, well, tomorrow's income that you could have put towards building more investments, buying more assets, is going to be going to paying off yesterday's credit card debt. So you won't even be able to invest tomorrow because you wanted to look nice today. But this is what's going to make you really wealthy. This is what's going to make you actually wealthy. And this is what's going to allow you to live that dream life without worrying about the price tag. And this is where you got to just make that decision for yourself, because America is a free country. If you want to live broke, you want to live stupid, you want to live like you're rich today, fine. You have the ability to do that. And there's a lot of companies that profit off of people wanting to look rich today. Credit card companies love it when you spend money on their credit card that you can't afford. Buy now, pay later loves it when you buy things that you can't afford. There's a lot of industries that love it when you spend money that you don't have, that you can't afford, that profit out of people being financially stupid. I don't want you to do that. I want you to do this because this is what's going to make you actually wealthy, but that requires you to sacrifice this so you can have more of this. And so this is where you got to understand, okay, I'm going to make some sacrifices on my spending. That way I can build some real wealth in my lifetime. Because most of us don't grow up with rich parents. Most of us don't grow up being told about financial education. Most of us don't grow up being told about entrepreneurship. I was one of those people. But once you start to learn it, you can't unlearn it. And that's where you want to be the first person to break that cycle for your family. That way you can actually become wealthy and then change the future generations for your family name. But it requires you to put that sacrifice in. That way you can change the success and the wealth that you and your family has. Growing up, I was always told about the importance of owning a home, because when you own a home, now you own this thing. You own this property and this land that you can work to pay off over your lifetime. And then you'll own this building that you can pass down to somebody else. You can build real generational wealth if you own your home. But over time, as I've become more financially educated, as I've become more successful, I've learned that that's one big lie. Sure, you can build some sort of generational wealth through home ownership, but that's not the only way. You can build generational wealth through the stock market. You can build generational wealth through real estate. You can build generational wealth through physical gold. You can also build generational wealth through businesses. So what I want to do today is go over 4.5 ways that you can build real generational wealth in this changing economy, because the reality, just look around you, the traditional American dream is changing, but this is where you want to be evolving with the times. That way you can understand, one, how to build wealth, but really how to build generational wealth that you can then pass down. The first way that you can build generational wealth is going to be the most passive strategy out of all the things that I'm going to talk about, and it involves the stock market. Now, there's 2 different ways that you can go about doing this. One of them creates an income stream. One of them builds a nest egg, and a nest egg means something that has value, this asset that has value that you could potentially pass down. So let me start by talking about the income stream, because over the last weekend, I was having a conversation with one of my friends who was talking about how nice it would be to have a second stream of income, and now how he wants to invest his money to create another income stream. So my family is from a state in India called Punjab, and a lot of people in my community in the business space either own gas stations, or they own convenience stores or liquor stores, or they're involved in the trucking business in some way. And the interesting thing about each one of these businesses is it allows you to build an income stream. Because if you own a gas station, for example, you own the building, you own the pumps, well, when people go there, they fill up their gas, they buy stuff from inside, you get paid. And the whole idea is you're going to build revenue from all the things that you sell, and this revenue will pay for all of your expenses, it'll pay for your employees, and then it'll put some money in your pocket every single month. It works the same way with the convenience store, it works the same way with the liquor store, and it works similarly in the trucking business. The whole idea is now you own something and it's paying you a profit every single month. Now, this is an active way of doing that, because if you wanted to manage one of these businesses, it takes a lot of work, it takes a lot of headache as well, because you got to manage these businesses, which many times are open long hours. And if you're not the one there, well, it's going to be hard for you to get paid. This is the way that some of these businesses work. Versus in the stock market, you can build a stream of income. It's not going to be as big as owning your own business, but you can build a passive stream of income. And if you do this over time, you can build a stream of income that will help fund you, your lifestyle, and it's a stream of income that you can potentially pass down to somebody else. Let me give you a couple examples. I'm not telling you what to invest in, just giving you a couple examples of how it works. The Verizon company today, VZ, that's their ticker symbol, they pay out a dividend at the time we're recording this video of just over 5% a year. And VYM is an ETF. It's known as a high dividend yielding ETF by Vanguard. And this ETF is yielding about 2.7% a year in dividends. Now, the thing that you want to understand here is, one, what's going on with these dividends? Because when you invest in a company on the stock market like Verizon, you become one of the owners of the company. Now, when you are one of the owners of a company, you are entitled to your share of the profits. This could be in the share price. So when the stock price goes up, you can sell your stock for a profit, or it could be in the form of a profit distribution, aka a dividend, which is when a company who has big profits literally takes some of their cash and pays it out to the shareholders, people like you who own the stock. So if you own one share of Verizon, you can get part of the dividends. Now, not every company pays a dividend, but the companies that do pay a dividend have to disclose how much dividend that they're paying. VYM is not an individual company. This is an ETF, which stands for an exchange traded fund, which means that now you don't have to worry about investing in just one company. You're investing into a basket full of a whole bunch of companies. Now, your investment isn't just reliant on one company or one stock. Your company is reliant on hundreds of different companies. Because in this case, if you invested all of your money into Verizon and you keep investing more of your money into Verizon each and every year, and then 10 years later, Verizon goes bankrupt, now not only do you lose your dividend, but you lost all the money that you invested into this company. So if you're talking about being a passive long-term investor where you don't have to worry about it, where you can just keep throwing your money into this thing that will keep paying you with cash flow, you want something that's going to be around for a long time. And the way that these ETFs work, especially the passive ETFs, is it's managed by a computer. So if a company goes bankrupt, if a company stops paying out a dividend, in the case of this high dividend yielding ETF, because if you want to be in this ETF, you have to pay out a dividend. Well, if you don't meet the criteria anymore, the computer will just take you out of the ETF and they'll put a new company in. So in this case, VYM is invested in just over 440 companies. I believe it's 443 companies at the time of me recording, which means that when you invest in this one ticker, you're investing in 443 different dividend paying companies. And this dividend yield that you're getting annually is from the average of these 443 companies that this ticker invests in. And now you can just keep investing money, whether it's every week, every 2 weeks, every month. You just keep investing money into this fund. And now what you're doing is you're building up a nest egg, because you have this investment of all these companies, which is also producing income. The income in this case is the dividend, which today is 2.7%. Now let's talk about return expectations, because if you have $1,000 and you invest this $1,000 into either one of these, well, after 1 year, you're just gonna get $50 in cash flow from Verizon, and in 1 year, you're gonna get $27 in cash flow from your dividends from VYM. Not a life-changing amount of money. However, it is a start. But the real way that you can build wealth through investing in stocks through dividends is now not just by investing money once, but by consistently, passively, automatically investing your money. So this is something that you want to be doing all the time. Every time you get paid, you want to keep putting some money in here. And now what you're doing is you're owning a piece of America. You're owning a piece, especially when you have ETFs, you're owning a piece of a bunch of companies that make America, America. And while you're doing that, you're also getting cash flow from your investments. Now you're getting cash flow from the dividends that you're getting your share of the profits, so you don't have to wait until you get paid. But now, if you don't need the cash today and you really want to build a real generational wealth, then you want to keep taking this dividend that you're getting and keep reinvesting it back into the company, because now not only are you investing a piece of your paycheck from your job, but now anytime you get paid a dividend, you're also reinvesting the dividends back into the company. That way you can buy more shares of this, because now you're building this little snowball. That way now you keep adding more snow onto it from your income, and then anytime your snowball produces more snow, it's going to keep building faster and faster and faster, because that means every year you're going to be getting bigger and bigger dividend checks. And if you keep using your dividend checks to buy more of the stocks that are paying you dividends, well, that means the next year you're going to get even bigger dividend checks. So now what you're doing is you're passively creating this new income stream. And now either when you get older, you can start selling some of it off to fund your own retirement, or the goal is now you can start living off of the income from your dividends. Now you don't got to reinvest it anymore. You just start paying yourself the dividends, and now you don't have to work for it.
Your ETF is paying you, and now all you got to do is start cashing in the dividends. You're not touching the principal. Now your investment balance isn't changing, but now you just start living off of the dividends. And then when you talk about generational wealth, well, you don't ever have to touch the principal, so you can just pass this down to the next generation, and now your kids or whoever have a stream of income, a passive stream of income from the investments that you work to build today. The reason why I'm so focused on the income side for the purposes of this video is because if we're talking about generational wealth, that means that by the time you die, you want to make sure that you have income to spend without spending all of the investment money that you built out. Because most traditional retirement planning has this whole model where you're going to build up this retirement nest egg, and then when you hit 65 or 67 or whenever, then you're going to start pulling cash out of your retirement fund, and you're going to pull out some cash every single year, and then the goal is by the time you retire, you have spent all of your retirement money. Well, that's great, but then you don't have any money or any assets to pass down. This is why everybody's so focused on owning a home. That way you have this sort of generational wealth. That way you have some assets to pass down. But what if instead of just owning a home and spending all of your money was producing you cash flow? That way you could live off of it without having to sell any of your assets. That way now you have assets that you can pass down that will continue to pay your family forever until you essentially sell these assets. You might have heard of something called the 4% rule. And the 4% rule says that you want to build up this nest egg, this retirement fund. That way, once you hit retirement age, you will be able to pull out 4% of your investment portfolio, 4% of your principal balance every single year for the next 30 years. That will be able to fund your retirement, that will be able to adjust for inflation. That way you can die with zero. Now it's great for your life because now you have money to spend, you have money to enjoy your life. But if your goal is generational wealth, you can't follow the 4% rule because the 4% rule means that you retire with zero. If your goal is to build generational wealth, you can't do that. You want to have an income stream that you can live off of. That way you have still this asset fund, this asset balance that you can pass down. And one way to do that is by having these sort of dividend paying investments. That way you don't have to touch the principal. You can just live off of the cash flow. You can just live off the interest. You can just live off the cash flow. You can just live off the royalties and then pass down the assets. The second way, and my favorite way to build generational wealth, would be through real estate. But when I talk about building generational wealth through real estate, I'm not talking about the home that you live in. I'm talking about real estate investments. Because let's think about this for a second. Let's say you become successful and you go out and buy $1 million home. Great. And now you paid off this home because now you want to be able to pass this home down to your kids and build real generational wealth. Well, what if your kids don't know anything about money and your kids don't make a lot of money and then you die? Well, now you pass down your $1 million home to your kids and they're going to feel so happy because, not that you passed away, but now because they have this $1 million home. But then what's going to happen is the summer's going to roll around and then they're going to get their $30,000 tax bill. How are you going to afford this $30,000 tax bill if you don't have the income and the financial education and the financial knowledge to be able to generate the income to cover that tax bill? And now if they can't cover the tax bill, they're going to have to sell the property. Now they sell the property, maybe they get $1 million, but if they don't have the financial education of how to use the money, then what's going to happen? Well, now they got $1 million in their hand. They're going to go out, buy a nice home for themselves, maybe a little bit smaller home, but they'll have a home. They're going to go out and buy a nice car. Maybe they'll buy a Rolex. Maybe they'll go on a few nice vacations, and then a few years go by and all of a sudden that money is gone. So you had built generational wealth, or so you thought, but now that generational wealth is all spent and gone, and now your kids have no way of growing the wealth because they didn't have that financial education. Now, obviously, financial education is extremely important, but I'll talk about that a little bit later. However, if you want to build real generational wealth through real estate, then you want to have a dumb-proof version of generational wealth, which means owning investment real estate. And that means now that you want to own real estate that is producing, again, say it with me, cash flow. The way that works is you're going to buy let's just say a home. It could be an apartment complex, it can be office building, it could be a retail building. There's a lot of different options for this, but you want to buy property or land that's producing cash flow. So you're buying this property not to live in yourself, but to rent out to somebody else. So you buy this property, now this person with a nice mustache or this lady with a nice braid, we call a braid in my native language Punjabi a gut, we call a mustache in my native language Punjabi a much. So we have this couple that's going to live in this property that's very happy because now they have this nice home to live in, and in exchange they're going to pay you $1,500 a month in rent. Now, if you do it properly, this $1,500 a month that you're getting in rent is going to cover your property taxes. So your tenants are paying your property taxes. It's going to cover insurance. It's going to cover your maintenance costs. It's going to cover your mortgage costs. And it's going to cover all the other bills associated with the property. And then after you pay for the expenses, the rest of the money is going to go in your pocket. So this is why it's a cash flow producing asset, because this asset, once you own it, is going to pay for all of your expenses and put some money in your pocket, and it can be very passive if you have the right property manager. Now, I'm going to give you a little bit of a disclaimer here, because when I first started investing in real estate, I don't have any real estate investors in my family. I didn't grow up learning about money. I didn't grow up learning about investing. So I had to figure it all out myself. So for me, becoming a real estate investor was anything but passive. I made every mistake possible. I didn't have any guidance. I didn't have a mentor when I was getting started. So I made a ton of mistakes. So it was very active for me, even though everybody says real estate investing is passive. In the beginning, it was very active for me to learn the process. But after a few years of meeting people, making systems, building the right team, having the right property manager, having the right contractor, now today, it is very passive for me. I don't know who my tenants are. All I do is I get a report every month or every quarter. Both of them I get a report. And all I do is I look at the reports, I see the revenue, I see the expenses, and I see how much net income I have after paying for all the expenses. So my assets are paying me every single month. Now again, I am getting cash flow that I can use, and I can use this money to live my life today without touching the value of my principal, without touching the value of the actual asset, which is the real estate. And so now, when you own this type of cash flow producing real estate, you can build real generational wealth, because if you can build a portfolio of real estate properties over the course of 2 decades, 3 decades, 4 decades, if you can build a number of real estate properties, which are putting a little bit of money in your pocket, let's assume that every property is only paying you $300 or $500 a month. Well, if you can build up a portfolio of, say, 10 properties over the course of your lifetime, well, that could be an extra $5,000 a month in passive cash flow. Well, the extra $5,000 a month in passive cash flow can fund your lifestyle, and if you can live your life based off of that, well, then you have real generational wealth, because now you can pass down your assets to the next generation, and if you have the team in place, well, now your next generation has a cash flow stream that they can live off of. And even if they're dumb with their money and they spend that $5,000 today on something stupid, well, at least they get another $5,000 next month. Now, I'm going to say this one more time. The goal is not to raise financially stupid kids. The goal is to raise financially smart kids that can grow and build the wealth. But if you're talking about real generational wealth, this is the way that it's done. And I'm just talking about building a system that is foolproof. And the way that you can do that is you need an income stream. That way now you're not worried about pulling out all of your principal while you're alive. You want to be living off of the cash flow, the income, the dividends, or the royalties. The third way that you can build generational wealth is through business. Now, I grew up in a traditional Punjabi house. And growing up, I was always told that the way that you become successful is by studying hard in school, get good grades, and get a good job. And for me, that good job was becoming a doctor, because if you can become a doctor, you can make a big salary. And if you make a big salary, you can save a whole bunch of money. Now, I'm going to get back to the saving part in just a second, but there's one little issue with that. The richest people in the world aren't doctors. They're not people who work jobs. It's people who own and start businesses. The real American dream, this is something that I learned from a lot of hardship and a lot of doing, is that the real American dream is the ability to build a business. Now, building a business is not for everybody. You have the most potential, though, through building a business and being an entrepreneur. If you can't be an entrepreneur and if you can't build a business, then the next best thing is to buy a business. You can do that through the stock market. The next best thing, if you're not going to be investing your money, is to earn a big salary. However, you're not going to be able to build real generational wealth through your salary alone. Because if you're a doctor, and let's assume that you're a good doctor, and you're making $500,000 a year or $1 million a year, well, after you die, your kids aren't getting your salary anymore. Actually, as soon as you stop working, that salary goes away. So if you really want to build generational wealth, you need an income that's going to keep paying you even after you stop working. Now, the way that you can do that is by owning a business. Now, this is where it gets a little bit more difficult because not everybody can start a business. Not everybody should start a business. Not everybody can operate a business, and not everybody should operate a business. However, everybody in America should own a business. And if you can't start it, the next best thing is to buy it. The reason why I say this is because I see how the American economy works, and I've seen how other countries in the world work, and America gives you this unique ability to actually invest and own businesses. You have the ability to actually build equity, and you don't have that ability in other countries. So you have the ability to actually build wealth here, which is why everybody needs to be able to take advantage of it. Now, I already talked about how you can buy businesses in the stock market section. When you invest in stocks, that's one way to do that. The alternative, obviously, is you can invest in franchises because, you can now actually own the business that way. But there's a lot more work. Or you can also invest in startups, which is becoming a lot more popular through crowdfunding platforms out there. But when I talk about this, what I'm going to be talking about is something a little bit different, being a little bit more active by creating your own business and really taking advantage of the new American dream, which is entrepreneurship. Now, I'm going to premise this. Again, building a business is very difficult. Takes a lot of time, a lot of hard work, and a lot of sacrifice. If you want to have every weekend, if you want to have every evening, if you want to have all the time at home to live the life that you want, well, you're not going to be able to do that when you start a business. You're going to have to make a lot of sacrifices, and I'm telling you this from experience because I didn't grow up learning how to be an entrepreneur. I had to figure it out all myself, and I had to make a lot of sacrifices. I had to work my butt off to be able to build a business, and it takes a lot of effort, a lot of hard work, and a lot of learning. However, you have a lot of potential upside if you are willing to put in the work. Every business at the end of the day works kind of like this, where you have the owners, and then you have the workers, and then you have some overlap sometimes. Sometimes the owners work in the company, sometimes the workers get equity in the company, just depending on what the company structure is, and sometimes the owner is the only worker. When you start up, it's just you and you are the owner and the worker, but this is how every business works at the core. Now, the workers are working for a salary. So you have little risk when you work for a company because you're going to get paid no matter what. Your biggest risk when you are a worker at a company is the company goes under and you lose your job. But at the end of the day, that is the root or the extent of your risk. When you are the owner, your livelihood is at stake with the company because now if the company goes under and you have a lot of debt, the bank can go after you for years until you pay off all the debt. If you're personally liable for other things in the company, you have to pay for all of that. So you are personally invested, you're personally signing the guarantees, you're personally the one that has to pay for all the contracts, all the loans, and all the things that it takes to build the company. So you're not working for a salary as the owner, you're working for an investment return. So you're working for profit. So the way it works now is the owners get their share of profit, the workers get the share of the salary, and now the owners don't have to work in the company. Once you build a business that's big enough, you can hire people to run the company, you can hire people to work in the company, and then you can take a step back and get your share of the profits. Now, there is going to be some overlap here typically where the workers in the company, you want to make sure that they're incentivized, and you want to incentivize them through getting some upside when the company grows. Now, this is just a personal opinion. Not every company does this, but one of the things that we do at Market Briefs, which is my company, is we operate with a revenue share, where now the workers get benefited when the company does well. The more money the company makes, the more money that everybody makes. Now, we don't do an equity structure as of this time because I have no intention of selling the company. So if I gave equity, then, well, you'd just be sitting on equity that you can't sell. Versus for me, that's why we do the revenue share, which is a way to benefit the people that work for us, the team, by giving you a piece of some of the profit. Now, this is what you got to understand now. If you are working to build a company and you're thinking like this, well, what you can do is you can work to build a company, and as you grow, well, then you can start to step away. You can train another CEO, you can train a team to run the company, and then you start to step away, but you still have the ownership. Now, you're no longer working in the company, you're no longer getting a salary, but you are still getting your share of the profits. Again, this goes back to what I've been talking about the whole video. You're getting cash flow. You've just built another income stream. Now, we're not talking about buying the income stream, we're talking about building the income stream. This is the most difficult. This one takes the most time. This one takes the most effort. This one also has the most risk, but it also has the most potential upside. Now, again, I'm gonna premise this one more time. You have to have the entrepreneurial mindset and the entrepreneurial bug, because I used to believe that anybody can be an entrepreneur. I thought that everybody thought like me, that everybody was willing to work 24 hours a day. I thought that everybody would be willing to make sacrifices. I thought that everybody would be okay taking these types of risks, but that's not the case. Not everybody is meant to be an entrepreneur. And sure, go out and try it if you're not sure. But if you hate it, then understand that maybe this is not for you. Now, going back to the generational wealth, if you can build a company that doesn't rely on you working there, now what can you do? You can pass the ownership of the company down to your kids, to whoever, and now they have this cash flow for the company that you've built. Now, again, if they don't have to work in the company, you don't have to worry about them running the company into the ground, because as the owner, they're not the one working there. Sure, maybe they can influence some decisions depending on how the voting rights work in the company, but the goal now when we talk about generational wealth is owning an asset, owning the business which is producing cash flow rather than being the one that's working there. If you're not able to go out and build a business, then you want to be taking this salary right here and investing that money into owning a company. And the way that you can do that is by investing your money in stocks, investing your money in real estate, investing your money in startups, because now you're building this equity into something that isn't the company that you're working at. The fourth way that you can build generational wealth, if you hate the idea of investing, if you can't stand the risk of investing your money, is by saving your money. Now, traditionally, when people talk about building generational wealth, this is what they thought. I'll own a home and I'll have a big bank account that maybe I'll be able to pass down this bank account to my kids. But the reality is we're in a time where inflation is not going to go away anytime soon. And inflation eats away at the buying power of your savings. Now, if we go back 50 years, your bank account paid you a real interest rate on your savings and you could see your savings grow. Back then, it made sense for you to save money. In fact, it was an investment. If you saved money in the bank, you even got a return on your money when you saved your money in the bank. Today, in this economy, in this time, that is just something you read in history books. It does not happen anymore. So when you save your money in the bank thinking that, hey, I'm gonna build a big savings account, I'm gonna be able to live off of my savings when I retire, and I'm gonna have such a big savings account that I'll even be able to pass some of this money down to my kids, well, you're setting yourself up for disaster, because one, your savings are gonna lose value to inflation each and every day, which means that when it comes time for you to retire, you're going to realize that this big bank account isn't going to buy you as much stuff as you thought, because when you were building it, inflation was less, and so things weren't as expensive. And then what happens is when you pass it down, now your kids get a big bank account, and again, the big bank account isn't worth as much as you thought it was going to be worth. So the alternative, if you want to just save your money, would be to save your money with something like physical gold, because gold is your inflation hedge. If you're looking for a way to build wealth through your savings, again, this is for people that don't like the idea of investing, they don't want to handle the risk, you're not going to get the income stream with physical gold. However, you can build better wealth with gold than you can with cash, because the way that I look at it is if it had $10,000 or 50 grand or 100 grand, doesn't matter, worth of cash, and 100 grand worth of physical gold, and I took this cash and I buried it in my backyard. In one hole, I buried the cash. In the other hole, I buried the physical gold. I believe that in 10 years, the physical gold is going to have more buying power than the actual cash. And so what you can do, if you want to save your money and you want to be able to pass these savings down, is instead of just saving your money in cash, save that money in physical gold. Maybe every month, you buy a little bit of physical gold and you just start storing it up, and this is something that you can then pass down. Now, the interesting thing, and the reason why I mentioned this, is because I've seen this in the traditional Indian culture. This is what people used to do. In the Indian culture, people inherently understood inflation. Although people didn't understand the technicalities of what's happening with inflation, the Indian currency, the rupee, has been an inflationary currency for a very long time. What that means is the currency has been losing power for a century now. And so people have understood this, although they might not have understood why. People understood that the price of things kept going up. So what people would do if they had extra of this currency was many times they would take this currency and go out and buy physical gold. Maybe there was jewelry, maybe it was gold bars, because they understood that gold was a better hedge. It was a better way to save money. And so people would buy gold as a way of actually building wealth. Even if they weren't very financially educated, it was a very common thing. And so now we're kind of seeing the value of that here, because when you have high inflation, you want to own something that is an actual store of value, not just a currency. Our paper dollars are a currency, it's a means of exchange. However, gold is an actual store of value because it takes time, effort, and labor to mine an ounce of gold. And that representation is in the price of the ounce of gold, versus it costs 12 cents to print $100, and the Fed can print money essentially on command with just the push of a few buttons. And the 4.5 thing, if you want to build real generational wealth, this is the most important one, is by passing down knowledge. It's more important than everything that I talked about, because it doesn't matter how much money you pass down. If the next generation does not understand how money works, it's going to be lost, it is going to be blown. And we don't want to raise a whole generation of just financially dumb people. So what you want to do is you want to teach how to fish instead of just giving a fish. It is infinitely more important. So when we talk about building real generational wealth, the best thing that you can do is start teaching your kids early. Teach them about money. Teach them what does it mean to create a budget. What does it mean to save your money? What does it mean to invest your money? What is an income stream? How do you create passive income? What is wealth? What does wealth look like? How do you manage your money? How do you create a plan for your money? These are things that you can start even when kids are very young, and it's just building the basic financial blueprint. And even if you don't know everything, that's okay. Start with what you know, because a little bit of financial education is a whole lot better than no financial education. And these are things that I wish that I would have learned when I was growing up, and I'm sure you did too. So use this as an opportunity to pass down the knowledge, because the goal should not be that I'm just going to work my butt off and I'm going to make millions of dollars and I'm going to pass it down to my kids so they don't have to worry about money. That doesn't do any good if they don't know how to take care of the money, if they don't know how to protect the money, if they don't know how to grow the money. The goal should not just be to pass money down. The goal should be to pass on education, because that education can help your kids actually thrive. And if somebody just has a whole bunch of money without knowing how it got there, without knowing the value of a dollar, well, guess what happens? You become spoiled, you become a brat, you just spend a whole bunch of money on things that you don't need, and eventually that money gets lost, and it creates a whole bunch of other mental issues. It can create depression, it can create anxiety, because it's just money without understanding it. And this is where understanding the knowledge is so important. How many times have you seen kids of just rich parents who are completely spoiled, who have no idea of how money works, and they just go and spend and blow their money? It's funny to watch on TV, it's funny to watch on Snapchat, it's funny to watch on TikTok, but these are real people, and you don't want to be one of the people that's raising kids like that. So make sure you spread the knowledge, that way people understand how money works and how to protect the money if you do want to pass it down. And even if you don't want to pass on any money, pass down the knowledge, because then it gives kids the opportunity to build their wealth themselves. I'm telling you from experience, I spent a lot of money on my education. I went to a good university, I went to law school, but I didn't learn a single thing about money or investing in the classroom, and now I make YouTube videos for a living. How you doing? So what ends up happening to so many people when you don't have this financial education is you graduate school when you're 20, 21